Markets Now is brought to you by the 5-year anniversary of Brevant Seeds. Here's to 5 years of not just winning, but collecting one game-changing W after another. See all of our wins at Brevant.com/wins.
Welcome to Markets Now. I'm Michelle Rook with Jim McCormick of agmarket.net. Lower grain and livestock futures on Wednesday. And Jim, let's talk about where some of this risk-off selling pressure came from. First of all, in the corn market, we looked strong technically yesterday. Did we just run up into the next level of chart resistance and see some profit taking, or what happened?
That's what it looks like to me. Yesterday we got up, we probed the downtrend line, took it out last night, but there was no follow through, even though the crop ratings dropped 2 points. And I think we started to pull back. I mean, right now in the big picture, from the winter high to the summer low is just shy of a 38% retracement. And then, so you could argue this is just a technical rebound going into fall harvest. And, unfortunately, I think that's what could happen. The argument, Michelle, is going to be, have we bottomed like we did a year ago in August? Or are we going to see that traditional late season grind lower? I fear that we're going to see a great late season grind lower just due to the pure size of the crop. Now, granted, the government's at 188. Most people are anticipating this crop to get a little bit smaller. We're in that same group. But if you drop that crop to, say, 5 bushels toward a 183, that would still give you an over 16 billion bushel production. We're hearing less than 10% of this crop's been sold, so that would leave you over 15 billion bushels unpriced. If a third of that bushels comes to the market, 5 billion, you're talking 200,000 contracts of corn. If half that 15 billion comes to market, you're looking over 350,000 contracts of hedge pressure. That, the question is, if you're an end user, are you going to bid up on that, or are you just going to wait for the hedge pressure to move the market back down? And, the MO on big crop years is they try to be patient.
All right, so some of this was a little bit of hedge selling pressure. Let me ask you, with as fast as this crop is drying down, are we going to have a lot of these early bushels coming faster to the market?
There's no doubt about it. I mean, when you talk to our clients all across the Midwest, we've got this corn. It is not drying down. It is dying down. Harvest is going to come quick, it looks like, and that will start putting that pressure on the market.
Jim, let me ask you about the crop ratings following back up on corn. 69%, good to excellent, down 2%. But does that really tell the story here?
What we're finding with these, ratings hanging in here, especially in the corn, I think the best in 9 years, the rating's going to argue this crop is probably above a 185 crop. Now we'll see what the government says in the September WASDE when they're actually getting into the field and looking at it.
Right. But even at a 185, when you look at the amount of disease pressure that we've had, that still seems really high. And then add on top of that the flash drought that we've seen coming into the Eastern Corn Belt.
The disease pressure has been hard, but if you sprayed fungicide twice, you're doing a lot better. Some guys didn't. It kind of depends when the disease comes in and hits that plant. If it hits it late enough, you're only talking a 1 or 2% drop in the corn yield for that field. If it hit it earlier in the season, you might see a much harder drawdown. So the fact of the matter is, Michelle, we just don't know. And, we're not going to know until we actually get these combines in the field and rolling, and then we'll get maybe a little bit clearer picture of it. And that's the bullish side of the story. Is, like I said, I do think the yields are going to lower. The problem is the demand, I think, is massively overstated. When the government raised this crop in August by 1 billion bushels, they offset it by raising demand. That I think just the fact of the matter is it's just unrealistic.
Soybeans down again today. Of course, we've talked about how the yield may be declining, but is it enough to offset the lack of China export demand?
Right now, I'm very fearful. It will not be the offset the lack of the demand, plain and simple. And I'm very fearful it could be really, really devastating. Up in North Dakota, if you can find a bid, you're getting a bid with an 8 handle on it. Essentially, the market's telling you we just don't want your beans, and that's because they harvest beans in North Dakota. They put them on the train and rail them out to the P&W and send them to the Chinese. The Chinese are not buying our beans. We are in a trade war with them for all intents and purposes, and they are trying to make it as painful as they can. And that is going to have ramifications everywhere you go, because we ship most of our beans to China from mid-September to roughly late December, early January. So we ship about 85% of what we export to China that period, to be exact. So you're talking potentially 500-600 million bushels of beans that normally go out in the fall, that if China's not buying, we're not going to be able to find a home for them quick enough. And that's just going to back that system up all the way through. So now you're going to get producers, Michelle, that normally plan on selling beans into the river market, maybe even Illinois, the Mississippi River, or out of the P&W, the rail market out of the P&W. If they can't move beans out because of the lack of demand from China, they're going to get stuck holding on to the beans. And that might force a producer who was game planning to store corn and move beans. He may be forced to move even more corn to market simply because of lack of on-farm storage. So we need to get this deal done. And each day we don't get it done, it's a crisis that I believe is building, unfortunately.
I know, but you just said we're not going to get it done in time for it not to be a crisis here during harvest or shortly after.
Right now, the best estimate we've heard is we've missed the September window. Brazil filled the Chinese needs for September. I've read and heard that they've got most of their October needs covered by Brazil, and Brazil is now starting to sell some of them in their November needs. So we are missing demand that I just don't think we're going to get back. On top of it, there's reports out of China suggesting they're going to open 5 to 6 million metric tons of beans out of their reserve. So to me, it feels like they're planning on a situation that this is going to drag out. And then you look what our government officials said at the Farm Progress Show. They were talking about adding $30 billion to the CCC fund. And I think, Michelle, that's critical because that's the fund that President Trump used during the first trade war to essentially put out those MFP payments. So when I look at what the government's saying, officials saying we need to fund that bucket of money, in essence, it tells me the government's planning on this situation lasting a long time, unfortunately. And like I said, if that's the case, it's going to become a storage crisis in the Midwest, I believe.
So does this mean that we slide into harvest here and make lower lows? Because there certainly was a lot of talk that we'd already put the low in August.
We could. I mean, if the bean market goes down, and essentially this market gets to the point where it's got to realize we're going to have to carry out not 290 million bushels of beans, but 600 million bushels of beans, you could see this market slide back down. And if the bean market's sliding back down, then that just entices a farmer to hold on to the beans he can, like we were pointing in North Dakota, which then means he's going to have to generate cash somehow, which means he's probably going to sell corn. And like I said, when you go to the corn, even if this crop is down to a 183 crop, 5.8 bushels off the current estimate, you're still looking at a 16.2 billion bushel crop. You're looking at a 1.3 billion bushel carrying. So you're looking at almost just shy of an 18 billion bushel supply. So that could be what pressures the market, plain and simple. As the head pressure comes in, the end users know that hedge pressure is coming, and they just sit back and they let the market fall to them. That's the $1 million question right now is, will the end users bid up and buy corn between 4 and 4.15, or do they wait and try to buy it closer to 3.85, which is my chart objectives?
Gotcha. So the wheat market, we're just right off of contract lows. We've been hovering at those levels, not able to stage a rally here. It's not really because we haven't had good demand. This is about what, ample supplies, or is it the fact that you've got corn down at these price levels?
Part of it's corn, but part of it's just plain and simple. We've got ample supplies of wheat in the U.S. and Russia's got a supply. They're trying to drop prices to generate revenue, to essentially get rid of their crop. And we're just, the fact is there's too much wheat in the world, and the funds are just not interested in owning wheat. One of these days they will, but right now, obviously they're not. In fact, we're just trading right here at the contract lows.
Cattle market, we set back today. What do you think? Is this routine profit taking, or is this the setup for a bigger, say, seasonal correction?
Well, right now, I'm going to argue it is, right now, I think, Michelle, you got to argue it is just kind of normal technical correction. If you look at the charts in general, whenever the market pulls back toward the 10-day, maybe the 20-day, the funds come in and they buy, and they've been defending those moving averages the whole way up. If you start seeing a close below those moving averages, then I'm going to argue you're seeing more of maybe a psychological turn in the market. Right now, the goal of the market is essentially to get prices high enough that the consumer says, enough's enough. I can't afford the beef. I can't afford to go out to eat. I'm going to eat pork. I'm going to eat chicken. I'm going to eat fish, because we're not going to increase the supply situation in this cattle industry. It's going to be demand destruction. And the real fear of the industry is when you finally reach that demand destruction point, price has been driven up by the tight supply, but a lot of fund money piling into it. So the funds start getting out because they say, hey, the party's over. We're probably in for a nasty correction.
So if cattle correct, do hogs follow because they've been benefiting from the rally going up and the funds have been piling in there?
I do think, unfortunately, they will go down, probably not as fast, because of what you are seeing the hog industry gain a little bit from these higher beef prices here in Northern Illinois over the Labor Day weekend. If you look what the stores are pushing, they were pushing pork. Buy one, get one free type of situation on pork chops. So I think the pork industry has caught some of those tailwinds or the coattails of the cattle. So if the cattle does go down, more likely you're going to see the profit taking in the hog industry as well.
Gotcha. Thanks so much. Jim McCormick with agmarket.net, and that is Markets Now.
You were right.
You were right.
You were right.
Well, you were right.
When you choose your seed brand, there's winning, and then there's...
You were right. Should have gone with Brevant seeds.
When you choose Brevant seeds, you don't just win. You get to be right. Don't just win. Win. Talk with your retailer or visit Brevant.com/win to get started.